All right. So our illustrious former president, Donald Trump, wasted no time getting back on message. I think he's been watching our show and he is trying to get back on message. So let's take a look at this campaign ad that they cut in response to the market collapsing over the last few days.
Disappointing July jobs report.
Bidenomics is working.
A rise like that is historically a sign that a recession is imminent.
This is Bidenomics.
What you're seeing right now in the stock market is what Americans have been feeling for the last 3 years. It's just a manifestation of it right now.
All that is called Bidenomics.
All right. And by the way, when did she become black? They cut that part.
Yeah, they cut that. Yeah, exactly.
Okay, so what the hell is going on? Now the markets, as I kind of thought would probably happen, they're up a little bit today. A lot of people in the market will call that a dead cat bounce. It means you have a tremendous drop and you get a little bit of a bounce. And then that doesn't mean the trajectory is going to change. Certainly the markets are not up today by anything in comparison to what they've been losing lately. So we're going to take a look at a couple of different perspectives here and what's been happening. A sudden global panic is upending financial markets and cratering the value of stocks, currencies, even Bitcoin. But economists say it's not a surefire sign that the country is headed for a downturn. The current sell-off, they say, is the result of investors having to untangle complicated, heavily leveraged trades that have artificially boosted stock values. A weak snapshot of the U.S. job market Friday added fuel to the fire, raising questions about whether the American economy is on rockier footing than previously thought, and prompting bets that the Federal Reserve might have to cut interest rates sooner and more aggressively. For anyone who doesn't know, the Fed has been keeping rates not really high in a historical context, but high relative to the very low interest rate policy of the last 25 years in an effort to crush inflation. The theory being if you raise interest rates, it'll slow business activity. People don't borrow as much money. It's just trying to cool off the economy. All three major stock indexes were down significantly Monday morning by as much as 4% as investors moved money out of equities and into bonds. Bonds are perceived as usually being a safer haven. Global markets were also reeling, with Japan's Nikkei 225 plunging 12%, its largest one-day drop in nearly 40 years, after an interest rate hike by the Bank of Japan last week. Although there's a chance the turbulence could lead to a self-fulfilling economic slowdown, analysts and economists say it's too soon to panic. The economy, by most measures, is still in solid shape. Americans are continuing to spend, and the stock market remains near the all-time highs it set recently. So this gives you some perspective on the year relative to the last week. So yeah, the stock market was up over 20%. It's still up pretty high. You have the Dow is still up 5%, and NASDAQ and the S&P are still up 12% even after this drop. Quote, "This is not the recession train. It's just a good old-fashioned market panic," said Joe Brusuelas, principal and chief economist for RSM US. Quote, "This is not a DC-inspired event about a slowing job market or the Fed being behind the curve. It's about a larger regime change where investors are adjusting to the end of easy money globally." That, I mean, the problem with that thesis to me is the Fed raised the rates. God, it's got to be like 2 to 3 years now. So why now? Japan for years has kept interest rates negative, making it attractive to borrow money against the yen to invest in higher yielding assets such as tech stocks. But the Bank of Japan last week raised interest rates to 0.25% and suggested that it would continue doing so, causing the yen's value to spike against the dollar and sending ripples throughout the global economy. Most immediately, that has led to a sell-off of tech and artificial intelligence stocks, including darlings such as Apple and Nvidia, though analysts say it does not come entirely as a surprise, given repeated warnings about bloated valuations well before the Japanese central bank's move. Fresh data last week showed U.S. employers added 114,000 jobs in July, far fewer than expected. The unemployment rate, meanwhile, rose to 4.3%, its highest level in nearly 3 years, raising urgent questions about whether the Fed was keeping undue pressure on the economy and waiting too long to take its foot off the brakes. The central bank last week decided to leave rates unchanged, saying it needed just a bit more time to see inflation keep falling before officials bring borrowing costs down from their highest level in 23 years. The overwhelming expectation then was that the Fed would finally cut rates at its next meeting in September once central bankers were confident that inflation was on a reliable path down. There's no meeting scheduled for August. Now we're going to take a look at another perspective, but this really shows you the disconnect between the stock market at this point and the real economy. Do you feel like the economy is doing well? Do you feel like things are good? They measure everything in terms of how is the investor class doing. Now that having been said, um, they really seem to be propagandizing the idea, and you'll see that from the next article. Nothing to see here, nothing to see here, no recession, all the fundamentals are good. And you might remember these same media outlets and these same analysts and these same consultants and these same money managers were all telling you that right up until the 2008 crash, most famously Jim Cramer. Don't sell Bear Stearns, you're being silly, don't be silly. Right? A few days before the whole company just completely collapsed. So there's only so seriously you could take outlets like this, like the Washington Post. AI, it does look like people got out ahead on AI, but maybe not, as we'll see in the next exhibit. Anything, Keaton?
No, I mean, I just noticed that yesterday this was a huge, I mean, this was the trending story yesterday morning. I mean, you could not get away from this. And so there was definitely a panic. And it seems like, there's the spin on both sides going on.
Yes. They're always eager to say nothing to see here within outlets like the Washington Post.
Right.
Now, one of the reasons I look at the financial press is that's kind of like looking at the racing forms. These are degenerate gamblers who look at Market Watch and CNBC and the Wall Street Journal. They don't care about Democrats. They don't care about Republicans. They don't care about spin. They care about making money off their bet. So perhaps CNBC has something a little closer to the truth. The U.S. may already be in a plain recession. Danielle DiMartino Booth. She is the CEO and chief strategist for Quill Intelligence and a former advisor to the Federal Reserve Bank of Dallas. Tino Booth explained how a weakening job market and increasing Chapter 11 bankruptcy filings signal that the U.S. is already in a recession. She believes it started sometime around last October. Additionally, declining house prices and increasing apartment supply suggest this trend may continue, she said. Artificial intelligence is a key tool for employers looking to cut costs, with the highly regarded CFO survey from the first quarter of the year showing that nearly 60% of companies overall are using AI. Quote, America's chief financial officers, tasked as they are with controlling costs in an economic downturn, have clearly demonstrated that AI will become a mainstay as Chapter 1 of the rollout of this technology continues to play out, replacing warm bodies with technology. Currently, employers are adjusting as they discover how AI best fits into their business models. DiMartino Booth suggested that for the next 6 to 18 months, AI is going to feel like a weapon of mass destruction. Now, my money is on the degenerate gambler financial news site probably getting it right over the Washington Post, which told you nothing of those figures, right? They told you nothing of declining house prices. They told you nothing of increase in Chapter 11 bankruptcy filings. These are the things that if you're a degenerate gambler who makes your money off of placing bets on how the economy is going to go, you pay very keen attention to those things. If your job is to get the Democrats reelected, you're going to tend to downplay those things. So I'm going to tend towards the CNBC take that we may already be in a recession, and these increasing unemployment numbers are just the first indicators of that. Now, of course, you do have people who've been saying for a long time that we're in an everything bubble, that crypto, gold, stocks, real estate, that everything has been insanely inflated by literally decades of artificially low interest rates and monetary policy that really encouraged investment, and that's inflated all of these assets across the board. And of course, a lot of them have been calling for a just complete collapse in all asset classes. Is this the beginning of that? I can tell you, as somebody who does take in financial news, just like Kathleen Kennedy murdered Star Wars as a genre, the economy is going to collapse next week. You had better put your money in a mattress. That is a whole genre of financial reporting. There are constantly articles written with that theme. And it really doesn't mean anything. My experience, and I think that anyone, even if you don't follow this closely, has seen this, the Fed will always bail out the investors. They will always bail out the investors. So could the markets tank? Sure. I mean, they did during COVID, right? What happened? The Fed came right in and bailed them out. Yeah, it collapsed in 2008. What happened? The Fed came in and bailed them out. Now, what may be different now is we're living in a world of de-dollarization. And increasingly, you're starting to have an organized anti-U.S. front in the form of BRICS, really trying to take down the U.S. and its satellites as the governing power of the globe. And if you did have that kind of collapse, would they try to take financial warfare means to exacerbate the collapse of the American economy by, say, pulling all their money out of U.S. treasuries to exacerbate that collapse, to exacerbate the collapse of the dollar? Because the Fed's ability to just print money and bail out Wall Street is dependent on the dollar being the world's reserve currency. If that's not the case, their ability to bail out Wall Street becomes extremely limited. That having been said, as a matter of policy, we've seen it again and again. If this everything bubble were to collapse, the Fed will rush right in to prop it back up.
Yeah, and from a media standpoint, from, a sort of cover the Democrats' ass standpoint, just a brief bit of, fun fact history. In 2008, we think of that campaign between Obama and McCain as a landslide. McCain was actually winning until September 15th, until the financial crisis hit. And that is what turned it. And so, a crash, a downturn, something that is perceived as cataclysmic in that way, that would put the nail in the Kamala Harris campaign coffin. And so I do understand the spin to say it's nothing to see here. And I also understand, obviously, on the Trump campaign side, saying this is the Kamala crash, labeling that. All right. It's not a surprise but the respective camps have taken that tack. And obviously, outlets like the Washington Post may as well be in the Democratic Party. They may as well be on the Democrat Party payroll.
Sure.
Yeah.
Sure. And one last interesting point to make. Over the last couple of years, once the Fed went on this rate hike regime, any indicator that fed the perception that the economy was slowing led to a boom in the stock market, because that means they're going to cut rates.
Right.
This time it didn't work out that way for reasons nobody's quite sure of, but most people seem to think it's because it happened right at the same time as the Bank of Japan raising rates and made everybody panic all at once. But typically bad news for workers is good news for Wall Street, but they panicked this time.
Please clap.